What do we got? We got Michael. He called in.
Yep, here you go.
Good morning, Joe and Al. Very much appreciate your efforts and time to make the podcast. Enjoy listening to it. Have an interesting question. Do you in your portfolio strategies ever think of using covered call strategies such as JEPI and QYLD? In a rising market, they obviously will not participate as much, but in a down market, they do have large dividend payments on the options they write that will reduce the downside. Just curious, in this environment where income is so hard to find, is it something that for a small percentage you might want to include in your portfolios? Thanks, and keep up the good work.
There's new ETFs that are have either a covered call strategy or they're writing or selling call options, more or less.
Right.
And what that means is for most everyone else that has no idea what that
you
that
need to explain it
is.
to us CPAs and laymen.
I was going to say, start with what's an ETF?
Okay,
Exchange traded fund.
Yeah, ETF's an exchange traded fund.
Yeah, okay, good start.
Usually, you would write a call strategy or an option strategy on individual securities. Now there's getting a little bit more robust, and they're doing them inside a wrapper of an ETF. So you can almost have like a hedge fund type experience inside a wrapper of an exchange traded fund at a very low cost.
Yeah.
So what a covered call is, or what he's referring to is that they're selling call options. And what that means is this, is that let's say I have a stock and it's worth $100. And let's say that stock produces a 2% dividend. So I get $2 of dividends per year and the stock price is at $100. So what they're doing is that they're selling calls and they're saying, hey, you have the right to purchase this stock, let's say at $105, and I'm going to charge you $2 for that option. So you pay me $2, so I get a $2 dividend plus a $2 premium from the option. So right off the bat, I just doubled my dividend yield, if you will.
Got it.
Does that make sense?
Yep.
So if the market goes down, no big deal. I still get the dividend and the call option premium.
Okay.
So I still get my $4. The problem is that if it goes above 105, let's say the stock goes to $130. Well, I gave the right to you to buy it at 105. So I lost the total upside appreciation of that stock.
So it hits 105 and I have to sell it to you.
Correct.
Or you have to sell it to me or however.
Correct.
Yep.
So you have the right to purchase that stock at $105 even though the stock shot up to 125 or 115 or 106 or whatever it is.
Okay. Got it.
Right. So I'm losing the forward appreciation of the overall stock.
Right.
Right. I'm locking in a price at a certain period of time, and I'm not going to receive anything more than that if the stock overperforms whatever that option price is.
Got it. But I don't really have any downside, do I?
Sure. I mean, if the stock plummets,
well,
I mean, you still own the stock.
I still own the stock. That's right. I forgot about that piece.
Right. But what I think Michael is saying is that, hey, well, you can make up from some of the downside because of the large premiums that they're receiving from these options.
Got it. Okay.
So it's an interesting strategy. So it's a way to create more income. Some of these products also uses leverage. So with leverage, you're leveraging the upside as well. So in this case, maybe I don't receive 4% or $4. I could receive 8. But now on the downside, that leverage is going to cut, like a knife either way, right?
Sure.
So the downside, there is no downside protection. I'm locking in on the upside, but I'm receiving a premium for locking myself in the upside.
Now, you can do a put for the downside, right?
Oh, let's not. Now he's just throwing out terms. So I think if someone's looking for income, I think if someone understands options and JEPI, what they do is they buy the S&P 500. What is interesting with QYLD is that they're using like the NASDAQ 1000. So, these tech companies never really issued dividends before. And, they're growth stocks. They're not necessarily like, the big, the big stapled stocks that, produce pretty large dividends. So, it's interesting. I think it's a viable strategy if you understand what you're doing. Are we putting these in our portfolios to our clients? Not at this point, but I mean, when markets are volatile or when interest rates are low, there's always different kind of, mechanisms that Wall Street will put out, and say, hey, you can get a lot higher yield, or here's a good way to get some income. So there's risk on not necessarily getting the full appreciation. You have no downside protection again. So you're limiting the upside with the full downside. So
got it. To get a little more income.
Correct. So you just kind of want to take a look at what you're doing there. But depends on the premium. So the premiums in Michael's case is saying, well, that's going to protect you a little bit on the downside because you're getting additional yield by the option. So.
Got it.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.